Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 18th, 2018. I had a request within the trading room from member Junuit23, if I pronounced that right, to do an update on some of the Canadian banks such as CM, RY, BMO, etc. Um, uh, Noting some potential bullish divergences on there. So I'm going to go over the charts of the Canadian banks that I follow, along with these here listed. There's a few, and what I'll do is I'll reference this post. The last time I did an update on the Canadian banks was back on December 18th. So not so long ago, just before the end of the year, and that was a request from another member. I have quite a few Canadians on the site, so I'm glad to do these updates when I get them. Just drop me a line in the trading room. So starting out here, before we get to the charts of the Canadian banks, I just wanted to mention some significant developments I've been noticing on the U.S., the big U.S. banks. This is XLF, the Spider Selectors ETF for the financial sector. It's chock full of the big banks, J.P. Morgan Chase, Citibank, Bank of America, etc. And you can see this is a 4-year chart using 2-day candles. But what I'm looking at is a very well-defined downtrend line. This downtrend line comes off the early 2016 lows. It's been tested many times. You can see the negative divergence that we had up on the highs. Leading up to the highs, we had divergences on this particular time frame. I'm using a CMF, Chaikin Money Flow. Divergences there, divergence on the MACD, divergence on the PPO. I'll get to the daily chart. And most importantly, we had a very impulsive breakdown that helps to confirm a breakdown instead of just limping through a trend line when you see an impulsive big red candle. And so far, the financials, especially in the last week or so here, have lagged the market considerably. We had a couple of the big banks come out and report they exceeded expectations, yet the stocks were met with selling. That is not a good sign. So both from just simple price action in the market, and technically speaking, these stocks are in a very precarious position right now. Again, I'm referring to the U.S. banks. We'll get to the Canadian banks here in a second. This is just zooming now down to 2-year. We're looking at a 4-year chart, same trend line. It goes off to the left of the chart, early 2016 lows. And you can zoom in and see how many candles, how many tests we've had. And on the few attempts that the XLF made to regain that trend line, we had a brief close right about on it, a hair above, and then a rejection there. And we also have it worth noting is pretty significant resistance just overhead. As you see, I draw that line around 28.27. So therefore, the U.S. banks, at least, are in a very precarious technical position right now because they are below trend. They're clinging to their 200-day moving average, and they're in this sort of tight slightly upwards trading range. I'll give it that. It's back testing. So they need to either break above 28.30 with conviction, or if you need to watch for a breakdown down below this recent consolidation zone, almost flagging type action if you look at it this way. Breakdown there will probably bring these stocks or XLF down to about the 25.50 area. And the reason I led with this, I really doubt we're going to see if that bearish scenario plays out. We do break down and the U.S. banks drop 7.5%. I doubt we'll see the Canadian banks rally. But with that being said, let's take a look at them. So on the left here, this is again, the post back from December 18th, and I'm going to go through that and just compare the charts then and now and where we might be going. So on back in mid-December, I had a scenario here. I pointed out this bearish rising wedge pattern. The charts may look a little different with the angles because I've compressed the chart on the right. It's not as much in landscape format, but these are the same trend lines. I have not changed these. So back here, we had just broken down. You can see on the left from that wedge. And I had a scenario of us going down to 60.50 followed by a reaction and then a continued move down to 54.50. What happened from that point? And this will be a common theme I'll talk about here. These wedges started to play out, but then we got sucked into what I call the New Year's rally, that incredible blow off top we had in the U.S. markets. And as most of you know, if you've traded, even if you're overseas, most other developed countries, their markets will follow the U.S. the U.S. has a big strong rally or big correction, it's almost certainty that you're going to see the overseas markets, follow their lead. Maybe not point to point, but pretty much in the direction. So that's what happened. So we had a breakdown, and essentially all that did is just come back to test the old high. So really, the breakdown was still very much intact. It's quite normal and common to see a kickback rally after a wedge breakdown, especially a powerful one. So going on, we then after the New Year's rally was over, we played it. This chart played out perfect. We went down. We overshot 60-50 by just a hair one day, and I refer to that as a momentum-fueled overshoot. When you have a tremendous amount of downward velocity heading into a support level, it's not just common; it's more than common. It's the norm to see that level, that support level, get overshot just due to that velocity. Imagine like trying to catch a fastball. The glove in your hand. If a pitcher throws a fastball, especially if you're trying to catch it with a regular mitt, it's going to go back a little before it snaps back and comes back. If that makes any sense, that analogy for you. But that's how I view those momentum fuel overshoots. And either way, it respected that 60-50 level several times. That's the reaction. There's the bounce that I was talking about there. And now the big question is there's some mixed technicals, and that's why I'm doing this video. We do have those divergences that the member had pointed out there. You can see these potential bullish divergences. I have them drawn out here. We don't have a clean crossover yet. The PPO has turned back up. The RSI is certainly pointing up. You can see prices made a newer low. So normally this is what I look for, and this is what I like to go long on for swing trades, especially on the daily time frame. Bullish divergence on the daily chart. But I'm going to show you some mixed technicals. I'm going to give you my thoughts on where we're probably headed with these, and I think I'm leaning towards this downside scenario. I'm leaning towards these divergences not playing out and being potential bull traps, if you will. But I'll also say this. There's a lot of these stocks. I'm going to go over this. I'm going to show you they're at resistance. And if nothing else, I'm going to be right or wrong on any call I make. That's about the only certainty I'll give you, is that I'll be right or wrong. But what I can tell you is where objective levels are. And a lot of these stocks are at support. So take BNS, for example. 60-50 is support. It was violated a couple times. And like always, if you go long, and my point is you can go long at support with a stop somewhat below. That was probably a stop rate. It's already happened once. That was a pretty big undercut. So at this point, I certainly think it's objective. If you're bullish on the Canadian banks or this company in particular, BNS, Bank of Nova Scotia, then you go long at 60-50 or as close to it as you can get for a bounce. And minimum target would be, these recent highs right here, somewhere around there, 60-53 or so, with a stop not too far below. That's an attractive risk reward. It's an objective trade. I can't promise it'll play out, but in my opinion, that's objective because that is again, a very well-defined support level that goes back, all the way here to early 2017. So that's that. Now let's look at the weekly chart. Here's some concerns that I have and reasoning why I think my original scenarios back from December may play out. What I've done down on the RSI below is I've circled every overbought reading on the weekly chart, again a weekly time frame. Overbought meaning a reading of 70 or higher on the RSI 14. Now, this one may have just fallen a hair short. I don't know if that was 69 and change or we hit 70 there. I can tell you right now. The RSI had a reading of 68, 61. Okay, so close enough. You don't have to split hairs on this stuff. If that's overbought, not technically over the 70 level, but close enough. So, all right, so where am I going with this? Well, okay, keep in mind too, this entire span we're looking at. Here's the 2009 lows when the last bear market ended in March of 2009. So we're looking at a scope of the entire bull market. And these have been the corrections every single time without fail. We had corrections in BNS when it hit the oversold reading on the weekly chart, some bigger than others. In fact, what I'm going to do for you right now is measure these out. Let's turn off this the tools and I'll measure these out. All I have to do is grab the top of the area. You're going to see a pop-up box. It should move to the left. Well, it won't move right now. The drop is in red on the bottom, so about a 15% drop from that one. Next one we had 26% drop. That nearly oversold reading or close to it was a 13% drop. And there's a point when I'm measuring this out. I'll get to that in a second. There's about a 15% drop. There was a big one. I pointed this one out back then at the time that the Canadian bank stocks were poised for a correction. That's a different post. That one dropped. That was about a 50% drop, nearly. So what I'm getting at here is you take the average, and there's 14.63, and then this most recent overbought reading so far from the highs, whether that's the high right there. Yeah, they're both about equal highs. The the maximum we've dropped so far is about 10.87. So point being is we're at the late stage of a bull market. Nobody can argue that, at least not statistically. Maybe this is some super bull that's going to break all previous records, but we know that we're most likely in the eighth or ninth inning of a bull market just by historical standards and everything else. You also have, so therefore, my point being that this correction so far, following that overbought reading, is well below the average. The other point to make here, you can see that we have some negative divergence on the weekly time frame. These are trend trades. I talk about swing trading a lot, active trading, short-term trades. When I see weekly divergences, whether it's bullish or bearish, positive or negative divergence, those set up the big swing trades. Those are the ones you want to position for, where you can take a position, whether it's a long or short position, tuck it away for at least a few months in most cases, and that's a trend trade. So those are rare to see, and we do have it there. So you have oversold coupled with that divergent high as well. And of course, we could probably draw a nice trend line up there that shows you that these have broken trend as well. So there's BNS. Most of these stocks look similar, so I'm not going to do the same exact thing on each of those. I'll try to spare you guys an extended video, but I wanted to point out, there are cross currents. There's cross currents in, these stocks. There's some cross currents in the U.S. markets right now. So, just like the U.S. markets, I think we're at a pretty significant technical level. So, either way, you can go long or not go long. These divergences, like I said, it looks like we were poised to cross over, and if you look really closely, the line's flattened out. I don't have a histogram up here that would show you. The crossover is still intact, but it's flattened out in the last couple weeks here. It's not a very clean crossover. There's not very impulsive buying off this level so far. And there's a possibility, like I always say, divergences are a big part of my trading, but they're not the be all end all. Just because I see a positive or bullish divergence doesn't mean that you're guaranteed a tradable trend correction or trend change, correction or rally. Uh, but it does help. So, that's why personally right now, would I short this stock? No, I'd wait to see these divergences fail, start to move back down, maybe take out these lows. Some other things might come into play, but that's my thoughts. So I'm a little bit skeptical, if you will, of these divergences. Let's just leave it at that. Move on to the next one. Scroll down. The next stock I covered in that video or that post, it was a static post on the front page, was TD, Toronto Dominion Bank. At that point in time, again, the date was the 18th, so we were right here. Let me try to show you where we were back then. So at this point, we were right here, and what happened, and this is also, I have it written on a couple of these charts. I truly, in my heart of heart, believe these wedges would have played out in 99 times out of 100, or maybe 9 times out of 10 at least, like they did right here. Bearish rising wedge, divergent high. This is one of my favorite setups. They're simple, effective, very profitable to trade, just like I love trading bullish falling wedges, on the long side. However, what happened is we had a crazy New Year rally, a blow off top in the markets. And what that did, it didn't foil this pattern. The breakdown, certainly we had another ramp up and we made new highs, but we did so by simply extending the existing divergences that were already in place. In this case, we had a second divergent high on the RSI, but the same divergence on the PPO. And you can see what happens after blow off tops. This is indicative. This is why we had such a sharp drop in, off those late January highs. Blow off tops don't end well. When the market goes nearly parabolic, the the ensuing correction is pretty powerful. And so you can see what happened from there. I was calling for a move down to 54.75 in TD. We fell just shy of that level. I put a blue line there. I left the 54.75 level up, but you can see so far we've stopped just above it. So my support level was set just a hair too low. So you might want to. I'll tell you where that level is. That blue line is at 55.09. So call it 55 right now. Um, so there's TD, and if you look at it from another perspective, using that same support line right here, we'll draw. Oh, no, we'd have to draw it this way. Let's draw a line like this, and what I'm looking at here, similar to the scenario I've laid out recently on the broad markets, and this one's actually fully formed, is a nice looking head and shoulders topping pattern. This being your left head. If you're not familiar, look that up. Head and shoulders topping pattern. Left shoulder, head, right shoulder, neckline. So pretty much a breakdown here. These stocks need to either giddy up and reverse and foil these patterns. Sometimes in a true bull market, you get a little breakdown, which is a false breakdown, and then a reversal back up there. So if you do short the breakdown, just don't become married to it. If we snap back with conviction back above there, give it a little room, then we're probably going higher because there are fewer things in trading more bullish than a failed breakdown of a bearish technical pattern that fails shortly afterwards. But if it does play out, I can tell you, just from simple TA, the measurement rule for a head and shoulders pattern, you take the distance from the top of the head to the neckline and you add that to where the pattern breaks down. And in that case, I'm going to give you my bear market target for TD if that turns out to be the case, and that's right around $54. I'm sorry, $50. There it is, because I have support just below the measured target. So if you're have the gumption to short and tuck it away as long as it doesn't exceed your stop. You have the potential on TD, if that head and shoulders plays out, to make about 10% from the breakdown level. And of course, support is support until and unless broken. So just like the other ones, if you want to go long here at support, you have a potential bullish crossover. You can see I circled that. PPO is curling over. You don't have divergence on the PPO, but you do on the RSI. So the case can be made. I can make a case to go either way here, but what's tilting me towards the bearish side is part of where we are in the business cycle. Everything else, both in the U.S. and as I would imagine Canada. I don't follow the Canadian economic indicators as much, but I do follow the fundamental picture in the U.S. Closely. And you can see these charts. To me, they look very toppy. There's that negative divergence. There's a trend line which we're flirting with. So if that head and shoulders on the daily breaks down, we've also broken trend here on the weekly chart. And instead of seeing just this 10% or so correction that we already had, might be a lot more like we had back here. So there's TD. Again, glass half empty, glass half full. I hate to give you guys wishy-washy analysis, but I would be remiss to not point out, both these potentially bullish developments as well as the bearish developments on here. Here's BMO. Back then, we were right about $79. I said bearish rising wedge divergent high. That the wedge breakdown did play out. It did go on to play out, but only after the blow off top. And again, this was a blow off top. Very few, if anybody, saw coming. So that just foiled the wedge. By the way, the wedge didn't break down. It never even gave you a false sell signal or a short signal. We just went up and then we broke that trend line right here. So this is the point we broke trend line support right here. And you can see I had us going down to 76.50 as an initial target. We actually hit that level, bounced a little, and then went down to my next target there. Sometimes I don't always draw out my complete scenarios. Let's see, I said, followed by a reversal down to at least the 76.50 level. So that was my initial target. And these were other targets. Otherwise, they wouldn't have been labeled there. And so you can see we've hit that second target and we've danced around it for a couple months now. So there it is. That's, 74.60. There's been a lot of volatility, and that's why we've chopped through. So what you might want to do is you put a different line right now under the recent lows, those two reaction lows. So if BMO goes much below 73.80, especially with conviction, it's probably coming down here in relatively short order to that 71.50 level. That would be my guess. Something else I forgot to cover on those weekly charts before, and again, these stocks all look similar. These are the big Canadian banks, and they're, birds of a feather flock together. So these charts are going to look very similar in most cases. The corrections all occurred at the same time. The big corrections occurred when the big corrections occurred. Again, you can overlay these charts, but it's not. It's pretty simple stuff there. Something I wanted to point out. Uh, Okay, here it is. I was looking for the right drawing tool. If you followed me for a while, one of my favorite, there's a lot. I always say that I have a lot of favorite trend indicators. And again, they're all taken in conjunction with one another and other developments such as, overbought readings, trend lines, support levels, all kinds of stuff. But one of the most effective and simple trend indicators that I use, and it works so well on many different securities, different indexes, and even different time frames. Right now we're on a weekly time frame, guys. If I don't make mention, it's always up here in the upper left-hand corner, weekly time frame. But it's this 9 EMA on the PPO. You can also use it if you don't have a PPO. A MACD usually does. It's a very close cousin to the PPO. But what it does is when that line, the 9 EMA, and I use that because that's the last of the two to cross. By waiting for the last of the two to cross, it helps me filter out whipsaw signals. And you can see it does just a beautiful job of defining trends. So in other words, at this point, the 9 EMA was above the signal line was above the zero line. That's a dotted line in the middle. And as the red arrow shows, you had a bearish cross. Then you had a bullish cross here. So these are trends, and it just helps to confirm the primary trend. Now, look at where we're at. And also note another thing that I always mention is once you cross above or below the level, that zero line so often acts as a back test, as support on a back test from below or resistance when tested from above. So it keeps you in the trend. And that's where we're at right now. So you see I have a green arrow. And by the way, if you just look up, here's the trends. You can see from here to here, bullish. I mean, if this isn't simple yet effective, then I don't know what is. Bearish. There's a bullish trend, tells you the trend was bullish there, tells you the trend was bearish there. And then at this point, it made a green cross. I could box it in, but it's the line, again, the white line has remained above. It doesn't, to me, get any simpler than that, and very few indicators are effective. Now, taken together with other indicators and confirmation, other signals that confirm or maybe refute your analysis, it works out even better. So where we're at right now, you can see this PPO is pointed lower at this point in time. We're headed lower right now. We have not crossed over yet. It is close. And again, I'm looking at the white line. Don't look at this negative value because that's giving you the PPO value. I don't have I can tell you what the reading is. It doesn't matter, a hair above, a hair below, but the point is it's there. PPO line's starting to curl up, but it's still pointing down. So if this continues, this is my point. We're at a very critical level. If we go much lower, we'll have the first sell signal on the Canadian banks, or at least on BMO, and you can do this on all those charts. You're going to see something almost identical. BMO, the last time that sell signal triggered was back here, and it doesn't capture the exact high. Other things help you do that, such as trend line breaks. Again, like I said, I use this in conjunction with everything else. There was an uptrend line that was broken at that point in time. You had the overbought reading. And then this, because we're using a weekly chart, this trend indicator comes a little bit later. If you use the same trend indicator on a daily chart, it will give you an earlier signal, earlier ins and earlier outs. However, go down to the smaller time frames and they're more prone to whipsaw signals. You have fewer whipsaw signals here on the weekly chart. So that's that. And again, I could all these charts mirror each other. BMO, I'm not crazy about this trend line because it only has a few reactions, but if I do use that trend line, we are now below trend. And we did have also, again, like the rest, a divergent high on the weekly chart and that overbought reading, which so far this would be below average on the shallow end of what these corrections were from overbought readings in previous years. Okay, the rest of that post, again, back from December 18th, goes on to simply show some charts here. Let me move this. Some before and after charts of how these played out in the past. And to reference that, the easiest way is just go to the front page and use that drop-down box, post by ticker, or you can use, the search field. Click on this, and there's several ways to search. You can search by ticker symbol, BNS. And if you are, if you're a Canadian, you're watching this and you trade the stocks that trade on the TSX, and you want me to chart because these are the same companies, but the values are different because they also have. I'm using the shares that trade on the U.S. exchanges. I'll be glad to give you a chart with my levels if you drop me a line in the trading room if you're a gold member. And then finally, what else did I want to look at? There were a couple others. Oh yeah, CM and RY. I don't think I covered those two. So CM. There it is. CM, same story. Like I said, I hate to sound like a broken record, but these companies are so related. These big Canadian banks. Um, that you can see the story is the same. They're sitting on a pretty important support level right now with CM, at least on the US shares. It happens to be $87. That same line would translate over on a chart if you use the Canadian shares. And there it is, potential divergence. It's even confirmed bullish divergence. It's just a matter of, I don't know if you watched my recent videos on the 15-minute charts and 60-minute charts, intraday charts of QQQ. We had negative divergences, and I said with a bearish rising wedge, and I said normally I'd be all over that, but I stayed long and expected those divergences to be burned out, which they were. Now, just yesterday, I finally closed out those long positions, but it allowed me to milk a lot more gains than I would have if I would have been just a mechanical trader, saying every time there's a bearish rising wedge with divergence, I'm going to short, or every time there's a bullish falling wedge. So again, these may or may not play out, and you want to go long here at 87 with a stop below. It's objective. Just don't fall in love with that trade. And if you want to short a breakdown, and especially add to that position if you see these divergences get burned through, because we're probably going a lot lower. And the last one was RY. Royal Bank of Canada, same story. Bullish divergence. Could certainly put a support level there. And again, these lines aren't random. If you're new to technical analysis, I look for the more reactions that I can find on a trend line, the more valid it is. So I see reactions all along there, and I think that's a pretty significant level. So there it is. There's a Canadian bank stocks. They either need to get up and start powering through these wedges and start moving higher impulsively. And if so, you can target the top of those recent ranges, possibly even those previous highs. But as of now, I'd be careful. At least that's what a stop is for. You can either stand aside a trade if you don't have confidence, or take it and stick with your plan. Have a trading plan before you go in, knowing what your profit targets are and what your stops will be if that trade doesn't work out, and stick with your plan unless the charts change drastically and tell you that the reason you went in for that trade, whether it was bullish or bearish, can no longer be made. All right, this has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.